2022 was a tough year for Tesla, and its stock price reached all-time lows multiple times. This was particularly hard on Tesla investors who had high expectations for the stock when the year began. This time around, investors are hoping to see signs of growth in the value of the stocks this year. And luckily for Tesla investors, here is one catalyst that could send the stock up to 10% higher in just one day. You definitely don't want to miss out on this one. Hey guys, welcome back to Tesla Tomorrow. Tesla recently released its earnings for the fourth quarter of 2022, and once again it has set the record for electric automakers. The car company reported fourth quarter earnings including revenue of $24.32 billion and earnings per share of $1.19. According to Tesla, automotive revenue is amounting to about $1.3 billion in the 3 months ending 2022. And including $324 million of deferred revenue related to the company's driver assistance systems. For this year, Tesla plans to go even higher, delivering around 1.8 million cars in 2023. The automaker says this represents a growth rate of about 40% compared to 2022. Tesla disclosed that it plans to grow production as quickly as possible in alignment with its 50% compound annual growth rate. And it added that this number will keep them ahead of their long-term goal. What does this mean for Tesla? Let's find out, but before we do, if you like this type of content, don't forget to like and subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Tesla car sales are gradually going off the roof, and this new goal could translate to a new milestone for the company. According to Tesla bull Dave Lee, 1.8 million deliveries for Tesla this year would mean that the car company makes a 37% year-over-year increase. What's exciting is that Tesla is already close to achieving this. In the fourth quarter of 2022, Tesla delivered 405,278 vehicles, which already adds up to more than 1.6 million annual delivery rate. By analyzing production rate also, this gives an even higher value, close to 1.8 million vehicles. This is using Tesla's production and delivery rates for the previous year, and these numbers are expected to increase in the coming quarters as the car company is still ramping up production in its factories. According to Musk, Tesla can potentially make up to 2 million, but he has lowered these vehicles and figures just in case of unforeseen circumstances. The Tesla CEO further spoke on the automaker's demand, stating that Tesla has seen huge orders in January year to date, more than it has ever seen in history. Musk added that orders have, at some point, gone even higher than production. So imagine if this production rate is sustained throughout the year, Tesla could potentially deliver more than 2 million vehicles in 2023. There's no doubt that there is a high demand for Tesla cars, and this demand is expected to keep increasing in the coming quarters. With major ramp-up at its factories globally, Tesla is also expected to meet up with this demand. And so, with production and demand rates on a high level, Tesla will record more growth in revenue, which could potentially cause the company's stock price to move up. It is important to note that there are several catalysts for Tesla stock this year, and this is only one of those. According to famous Tesla investor Cathie Wood, she sees big gains ahead for Tesla in the future. Wood said that just from electric vehicles, there could be almost a 5-fold increase in Tesla's stock during the next 5 years. The ARK Invest CEO added that for those who believe in autonomous cars, it's closer to 13 times during the next 5 years, and so she remains bullish on Tesla. Wood predicts that the company's stock could reach 5 times the recent price, which would be around $653, and 13 times at $1,699. Needless to say that there is a lot for Tesla to do in order to reach this price. After a brutal year for technology stocks, individual investors have lost their appetite for buying the dip. The dropping has been fueled by rising interest rates that batter growth stocks, worries that demand will erode if there's a recession, and concerns that Musk's acquisition of Twitter will divert his attention and increase his sales of Tesla stock to keep the social media company afloat. Growth stocks like Tesla suffered major hits in the previous year during the numerous hikes in interest rates by the Fed. The Federal Reserve reeled off the most rapid series of rate rises since the early 1980s, raising its benchmark federal funds rate by 4.25 percentage points in a bid to combat high inflation. Most Fed officials further projected that the rate would rise to a peak between 5% and 5.25%. Tesla was among the biggest drags on the index, and Musk's sales of Tesla stock and the distraction caused by his Twitter takeover didn't help. According to Ipek Oskardskaya, senior analyst at Swissquote Bank, it feels like the confidence in Tesla is gone, and the automaker's fairy tale suddenly ended. She added that investors are more eager to see how the looming recession will hit Tesla demand, how competition from other electric vehicle makers will impact Tesla's market share, and when Elon Musk's Twitter affairs will stop hurting Tesla. The Fed raised rates 7 times last year, and recent government data and business surveys have pointed to a steeper drop-off in manufacturing activity. The central bank's rate increases are aimed at slowing inflation by reducing demand, and there is ample evidence that this is exactly what is going on in the business sector. However, there are signs that the Fed may decide to approve a smaller increase in interest rates owing to officials' growing confidence that the economy is responding to their efforts to curb demand and bring down inflation. According to recent news, US Federal Reserve officials are preparing to slow interest rate increases and debate how much higher to raise them after gaining more confidence that inflation will ease further this year. In recent public statements and interviews, Fed officials have said slowing the pace of rate increases to a more traditional quarter percentage point would give them more time to assess the impact of their increases so far as they determine where to stop. Fed Vice Chair Lael Brainard also said that raising rates in smaller increments gives the firm the ability to absorb more data and probably better land at a sufficiently restrictive level. However, despite the intense tough times that Tesla had, for the automaker's diehard fans among retail investors, the risks to demand on Musk's preoccupation with Twitter haven't been enough to sour them on a stock that became one of Wall Street's highest flyers during the pandemic. Despite the continuous drop in Tesla shares, retail investors continue to scoop up more shares of the automaker, and this is likely because of the car company's expected plans for the year. Also, issues of a perceived drop in Tesla's demand may likely be going away. Recent reports also cited that Tesla's so-called demand problem may be an advantage. According to recent news, Tesla is trying to use its overbuilding problem to maintain market share, and the automaker's price slashes and piled-up inventory pose a bigger problem for rival startups. Tesla has the opposite problem of its competitors right now, and Elon Musk is racing to use it to his advantage. The car company can afford to lower car prices and still record significant profit from these cars. The EV company is reportedly grappling for the first time with a bloated inventory and softer demands for its cars. And in an attempt to spin this challenge into an advantage, Tesla has implemented a series of price reductions on its most popular vehicles in the US, Europe, and China. Tesla is offering its more popular cars with discounts of up to 20% of the original sticker price, a move that in the US alone could cost Tesla as much as $7 billion in profit this year. But analysts say it's a long-term bet to keep Tesla's spot as the leading seller of electric cars. Tesla may soon be sacrificing its profits for market share in the short term, but in the long term, it should benefit significantly from this. The car company has ceded ground to competitors in recent years, dropping from nearly 80% of the EV market in 2022 to 65% last year. And so this aggressive move to cut prices may be just what Tesla needs to go back into the market and get those shares back and maintain its leading position in the industry. The price reductions also allow the company's vehicles to qualify for an additional $7,500 tax credit as part of the Inflation Reduction Act. Even Cathie Wood thinks that Tesla's price cut is a smart strategy, adding that the automaker is going to be very aggressive in pricing. Tesla's discounts have already triggered a surge in buyer interest rates in the US and in particular for the Model 3 and Model Y. Although this change to EV tax credits could eventually exclude Tesla cars from the credits, interested EV buyers will likely want to snap up a Tesla before discounts dry up. Musk has said that it's always been Tesla's goal to make cars that are as affordable as possible, and that is no doubt what the automaker's doing. And in return, it gets an even bigger market share. Do you think Tesla can produce up to 2 million vehicles this year? Let us know down below. And if you'd like to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.